All right, well, let's get started. Good afternoon and welcome to our first virtual alumni panel discussion featuring three dynamic Duquesne graduates. I'm Sarah Speary, the AVP of Alumni Engagement, and I'm excited to have you all join us today as our panel discusses the topic of financial strategies during a time of crisis. Our goal today is to start with understanding the current financial crisis and how investors and the market are reacting to it. We'll ask some timely, frequently asked questions of our panel of financial experts in order to highlight a holistic approach to financial planning. We realize everyone's financial situation and strategy is unique, and our alumni panel is here to address overarching, time-appropriate advice so that you can take away some strategies to consider or discuss with your financial advisor, spouse, or family members when reviewing your own financial plans. Before we get to the introductions of our esteemed panel of alumni, and I turn the program over to our moderator, I have a few brief housekeeping items to go over. First, I'd like to thank Audrey Tierney, Associate Director of Alumni Engagement, for helping with the arrangements for this program and for managing the technology during the panel. Throughout the presentation, your microphones will be muted, but you're welcome to submit questions through the chat feature found on the toolbar on the bottom of the screen. Our moderator for the program, Dr. Bhaskar, will start with some pre-submitted questions, and then time permitting, he'll ask any additional questions submitted through the chat feature found on the toolbar on the bottom of your screen. We have allotted 1 hour to this program, and we'll do our best to answer as many questions as we can during the hour. Now for some background on our panelists. Let's start with ladies first. Shauna Othman is the Vice President, Portfolio Management at C.S. McKee and a double duker from the Palumbo-Donahue School of Business. Since joining C.S. McKee in 2003, Ms. Othman has served successfully as a portfolio accountant, performance analyst, and investment analyst before adding her current portfolio management responsibilities. Her experience has given her a solid background in investment management, stock research, account management, and cash flow management. Ms. Othman holds the Chartered Financial Analyst designation, as well as an MBA in finance with high honors from Duquesne University. We're happy to welcome Shauna here today. Robert Fergasso is a member of the Duquesne Century Club of Distinguished Alumni, the School of Business Advisory Council, and proud graduate of the School of Education. With more than 4 decades of experience in the investment management and financial planning fields, Bob leads Fergasso Financial Advisors as Chairman and Chief Executive Officer. He has combined his experience in the industry with his entrepreneurial spirit, constructing a vision that has positioned the firm for growth and longevity. He has paid particular attention to refining the firm's processes and systems in order to make the inner workings of the company extremely efficient, including rigorous investment management processes and personalized financial planning for each client devoid of proprietary product bias. Bob has been honored by many national and local organizations, including Barron's Magazine, and was named Most Admired CEO and Top Executives by the Pittsburgh Business Times in 2016 and the 2015 Veteran of the Year by Veterans Leadership Program of Western Pennsylvania. Thanks, Bob, for bringing your expertise to this panel today. Matt Helfrich graduated from the Palumbo-Donahue School of Business with a degree in investment management and serves on the school's advisory council. He serves as president of Waldron Wealth Management, where he leads Waldron's strategic vision, brand, and value proposition, and overall culture of the firm. Since 2002, Matt has served in a number of roles, including chief investment strategist and chief investment officer, where he was instrumental in creating and refining Waldron's investment discipline. More recently, Matt has been focusing on expanding their service offering across multiple generations of clients and leveraging technology to enhance client experience. Matt is in the media frequently and has appeared in Wall Street Journal, Barron's, Private Wealth Magazine, Wall Street Week, Forbes, and Smart Money. Matt is also a presenter at numerous industry events and association meetings where he speaks about mentoring clients' children and running a company with team members of diverse age ranges in the financial services industry. I'm glad you could join us here today, Matt. Now, without further delay, I'd like to turn over the program to a face that is familiar to many who have taken classes in Rockwell Hall, Professor Vashishta Bhaskar. Professor Bhaskar has been educating students in finance in the School of Business for 35 years, so was the obvious choice to moderate this program today. Professor, thank you for taking the lead in serving as our moderator. I'll turn the program over to you.
Thank you, Sarah. Thank you everyone for joining in. We have a treat for you. We have an extremely esteemed panel who are experts in their field, as well as I'm happy to look at the list of people who have joined in, and they are themselves very informed, very curious, very informative, and very successful in their own rights. So I'm glad you are a part of this. We could learn from you, and I'm sure you will learn from the panel themselves. I won't spend too much time on myself or other things, so I will get straight to the point. I would like to address it in three different formats. The first one is to set the stage for what is happening today and why we should be concerned or not concerned, and concerned to what degree. For that, I turn it over to Bob Fragasso, and I will like to ask you the following specific questions, sir. You've seen many ups and downs in your career, and you have seen governments come and go. You have seen tax policies change. You have seen priorities around the globe change. So change has been a part of your life throughout. But for some reason, what we're going through right now seems different from the ones previously, because it seems to be out of control and so on and so forth. Obviously, this has effects on your people's wealth and future lifestyles. So would you be able to address those issues from your experience and see how different this is and what people should be focusing on?
Well, thank you, Dr. Bhaskar, for an exceptionally well-posed question. There's a phrase that's been used pre-pandemic as well as now, and that's new paradigm, which is a phrase that I reject because there really aren't any new paradigms. History repeats itself in cycles. It just comes dressed differently each time it comes around. And in no way am I looking to minimize the seriousness of this current situation. It has, as you correctly said, impacted people's lives, their wealth, their way of living, their way of doing business. There will be casualties in our economy and the world economy as a result. I don't think I'd want to be a restaurant owner right now. I don't think I'd want to be the CEO of a hotel chain. But our economy has always gotten through. Let's put this in a little bit of perspective, though, before I reach that conclusion. If we go back in history, and I've been doing this for 48 years, and my research and reading goes back centuries. The earliest modern times of severe downturn, there were in the 1900s, but in the 20th century would be the crash of 1929 that ushered in the depression of 29-32. Markets fell by 80%. And the duration of that crash was 3 years. Then there was a respite, and then there was a repeat for another 2 years. And the entirety of the 1930s is called the Depression. But interestingly, during that time, the market fell from 29 to 32. Fortunes were lost. There were the suicides, that story's overdone. But the people were ruined by this. But yet the markets recovered. And if we go to that very same period, a decade earlier, World War I and the Spanish flu epidemic. The Spanish flu epidemic was worse than this current epidemic in many ways. One, it was longer. We see the end of this coming, and it's going to be punctuated by the development of a or several vaccines, and we'll start to recover. We've already in the markets recovered. The S&P 500 is back to its pre-pandemic levels. Let's fast forward. By contrast, the combination of World War I and the Spanish flu killed 50 million people worldwide in a 2-year period. Almost 700,000 of those occurred in the United States. Fast forward to the World War II. We had similar situation. Millions of people were killed. The entire world was in a conflagration. We had many things happen since that period of time, culminating in, prior to this, the Great Recession of late 07 to early 09, where markets fell 60%. You say, well, wait a minute, that's ancient history. That doesn't mean anything now. And I said, well, be careful. Be careful you don't fall into what I call the teenage syndrome. And the teenage syndrome says, those of you who are parents to teenagers or grandparents to teenagers, says, nothing that came before me matters. Only what happened since I was born is important. And that's not true, because we can learn from the history of all of this and go through recurringly. If I look at all of the downturns that have occurred, and we have this on our website, the average downturn was 25%, similar to what we experienced. The average recovery within 9 months of the downturn, there were some exceptions, 35%. So let's grant the recurring nature of downturns and recoveries. The market has never gone down and never come back. Has never gone down where it hasn't come back. So how do we handle ourselves during these periods of disequilibrium? And you, in your question, Dr. Bhaskar, posed it very well. What do we need to pay attention to now during this? Now, I'll rephrase it. What do we need to pay attention to all the time as we seek value in our economic endeavors, whether it be our own business or our investment portfolio? It's how we handle ourselves during the inevitability of this recurring cycle of economic history that will determine the outcome, not the event itself. So there is no new paradigm.
Thank you. Let me go to the next question, which still with Bob. So given today's environment, you're recommending that we should stay the course in a steady way in our portfolios and not panic.
That infers that you had the right course to begin with. Assuming that's true, then the answer would be yes, but there is a strategic positioning of a portfolio, and then there's a tactical positioning. So as we go through normal market cycles, one must adjust the tactical allocations in a portfolio as to where we are relative to where we are in the cycle. But in times like this, you may want to make some adjustments. So do you want to hold the industries that are most impacted by this pandemic? Or do you want to average down by buying some more of them, assuming a recovery? Those are things that you and your investment management team have to decide for you, and I'm not going to opine on that. But if the overall allocation of your portfolio is correct, and it should be asset allocated with a worldwide perspective, and I think we're going to get with some of the questions, get more deeply into this, so I won't, then the answer is if you've done it correctly, you leave your allocation where it is, where it should be, and then you just move tactically within the allocation to make adjustments relative to the current time. Now, I'll give you another analogy. If you went into a hospital emergency room because you fell down, you hit your head and you were bleeding, and the emergency room physician looked at you and said, "Oh my gosh, he's bleeding," and became very flustered. Well, think about that in terms of one's own reaction to a market downturn. Are we emulating that hypothetical emergency room physician as we look at our portfolio? Or, as we would expect, that person would calmly, rationally assess the situation and treat it. That's what we have to do with our finances, not run around waving our arms.
Thank you. For Matt, I have a question which deals with markets and asset allocation. Primarily, when people talk about asset allocation, they mean mostly stocks and bonds. However, you in the financial planning industry have a variety of asset classes in which you can invest, such as gold, real estate, or other alternative investments like commodities and so on. So my question to you is, do you recommend that people broaden their asset class diversification? And then given that, what would be a good way to go about doing that? For example, you could buy metals in a variety of ways. You could invest in oil or commodities in a variety of ways. How do you handle it, or how would you recommend people look at it?
Yeah, and that's a great question, and to even build upon what Bob mentioned earlier, everyone has to assess their own personal financial situation, whenever they're approaching these things. And again, it's building a strategic asset allocation, and certainly when you build a strategic asset allocation, the way people naturally look at it is stocks and bonds, and do I use a 60-40 portfolio? But everyone's portfolio is going to be a little bit different. And then certainly, as you're starting to introduce some of these other asset classes, whether it be, as you mentioned before, Professor Bhaskar, if you're starting to add commodities, if you're starting to add real estate, if you're starting to add other alternative investments, those are adding other degrees of risks involved in it, whether it be lack of liquidity, whether it be other credit risks associated with it, whether it be the fact that some of those, whether it be metals aren't even producing a cash flow. So how do you properly assess the value of it? And then when looking at that, it's important to understand that the taxation of those is much, much different than just holding your general equities or your general bonds. Most people don't realize that gold and other metals are taxed as a collectible, which has a different tax treatment. And certainly real estate, depending on how that real estate is owned, and whether it be owned directly or whether it be owned in a partnership or whether it be owned in a mutual fund or ETF, that's going to have certain tax attributes that apply to it as well. So all those things run differently, which means the location in which you put those assets, whether it be your IRA or other tax qualified money, or your non-tax qualified or just your general investment account, those are going to be important when you start evaluating these things on an after-tax basis. Because as most people don't understand, when you start stripping out the taxation and you start understanding that these certain instruments may have other higher fees associated, you have to understand, what's your after-tax, after-fee return for these asset classes versus the other asset classes that are out there. And you can approach these in a variety of different ways. Certainly with metals, you can whether you do it through the futures market or whether you do through ETFs or whether you do mutual funds. Each has their own unique traits behind doing it. The one caveat that I would say that when you approach these types of things is you need to understand that those commodities or those other metals, those types of asset classes don't have cash flows associated with it. So the typical way one would value those assets or try to derive a value to the asset is different than if one were to take a look at equities or one were to take a look at bonds, or even if one were to take a look at real estate. And certainly real estate opens up its other hosts of things to consider as well. Are you buying a unit to rent? Are you going to be partnering with someone in a commercial property, or are you just going to buy a portfolio of real estate investment trust or publicly traded real estate securities? Each one has its own characteristics behind it. Just speaking, going back to what Bob mentioned before, I don't know if I would necessarily be looking at a portfolio that was driven in the hospitality sector of the real estate economy, but certainly warehouses, or certainly, if you are doing your due diligence to own a piece of property and you assess the value of that piece of property appropriately, and you don't mind owning and running it, it can be another component to include in one's overall net worth and one's overall wealth.
Thanks, Matt. Now comes the million-dollar question, which we deal with every day for Shauna. Are markets overvalued? Are they correctly valued? Where are the risks, and how do you navigate these markets? Because you have to manage the money, actually make decisions on stocks you buy, industries you focus on, and how you select your securities. So the question is, what is your view on the market? And given where the markets are, the Fed has played a major role. At least I think the Fed has played a role in where the markets are. Do you see that continuing? Do you take that into account when you manage your money? And what would you recommend for people to look for? What would be a headline which which would indicate, I think the worst is over, or, hey, this is terrible. What would bother you if you saw something, or what would spur you to focus more on your investments?
Sure. It has been a momentum and growth at any price driven market. And a lot of times those growth at any price stocks have had debt-ridden balance sheets. Those are the ones that have led the market higher. The Russell 1000 growth has outperformed the Russell 1000 value by over 30% year to date. And the Russell 1000 growth is now trading at 37 times earnings versus the Russell 1000 value just trading at 17 times earnings. So obviously there's just been an indexing explosion over the last decade, and it's been an extremely narrow market. The 5 largest companies are now 23% of the S&P 500 and 47% of the NASDAQ 100. And they're the names that you would guess. They're Apple, Amazon, Microsoft, Facebook, and Alphabet. So these market dynamics are pretty similar to the dot-com bubble of the 2000s. And the difference this time around, though, I think, is that there has been massive Fed intervention that has kept interest rates artificially low for an extended period of time. And obviously, the million-dollar question is, when will that change? We do think that the massive quantitative easing could lead to inflation if there is a successful vaccine or a treatment for coronavirus. In that instance, demand for goods and services could outstrip supply. And in that instance, growth stocks do tend to underperform in inflationary environments because they rely much more heavily on future earnings, which are eaten away much more aggressively by inflation than value stocks. So right now, we're recommending don't go to cash, but have a mix of growth and value stocks in your portfolio. Because this environment, we don't see it changing anytime soon with the massive Fed intervention. So growth could continue to lead the market higher, but there is going to be a catalyst someday for value stocks to outperform. So they are going to have their day in the sun eventually. We just don't know when. So have a mix of growth and value stocks in your portfolio. Diversification is always key.
Thank you, Shauna. Now for some specific items which the participants have asked for. So I would ask you specifically, these relate to the implications of policies being followed by the Fed and the government. By and large, they fall into 2 categories, and I will ask each one of you to opine on those. One is deficit spending a problem? And it has been going on for a long time and ballooned in the last decade or so. Why isn't inflation picking up? And will inflation be a problem given this? And if that is the case, then interest rates are inevitably will rise, and then there'll be stagnation, or the markets might not do as well. So is this, are we following the sound good policy, or should we be weaning off this possibly? So let me start this by asking Matt. What do you think about deficit spending, inflation, and any good and bad effects on the economy?
Well, I think as we saw in 2008, 2009, when the last time we had a significant, certainly a financial crisis, we had some deficit spending at that point. And then, going back to post-World War II, I think it's the last time we had deficit spending to this level. Deficit spending without a purpose is certainly a negative. I think right now, you're not seeing inflation pick up because this deficit spending that we're seeing right now is being used to support a pretty high employment number. I mean, we had 15% unemployment. Most economists at one point thought it was going to be 30%. And the largest component of the price of goods and services tends to be the labor costs associated with it. Some people think it's commodity. Most people think it's commodities, but really not. It's labor costs. So, to the extent we have this fair amount of labor slack in the economy, you're not going to see inflation tick up to the same degree. So I'm not necessarily worried about the deficit spending as it stands right now. You know, to Bob and to Shauna's point, you know, if we get a or several vaccines and people take them and we get back to some semblance of normalcy again in the labor market, absorbs a fair amount of that slack, well then yeah, I think you're likely going to start seeing a pickup in inflation again. Certainly if we keep having the same amount of stimulus out there now, and certainly the Fed is helping to monetize that amount of debt that's out there. So yeah, I think you could see some inflation pick back up. I don't think it's going to be, you know, next week or the week after, but as things go along and we continue to print and to monetize these deficits that are out there, and we continue to have that reduction in the unemployment rate, that you know, down the line is definitely would see an inflationary impact associated with it. You're on mute, Bhaskar.
Thanks. A quick follow-up to that based on what you just said to asset allocation decisions. Given that interest rates will rise somewhere along the line, what role would bond holdings play in your portfolio? Would you tend to reduce them, increase them because of the price risk associated with higher interest rates and bonds coming through? So will bonds play a more significant role or a less significant role in the medium term?
Yeah, again, you know, sometimes people tend to paint bonds with the same broad stroke as the U.S. Treasury. You know, not all stocks are the same, not all bonds are the same as well. As you start going at the various levels of maturities, even as you start looking at municipal bonds or different types of credit, even some types of credit, whether it be investment grade or non-investment grade, which they carry their own risk, credit risk. Even getting down into some bonds like convertibles, again, that carries its own risk. They actually have a more positive correlation to stocks. They're going to move a little bit more like stocks, and they tend to not have the same, as rates rise, they tend to not have the same movement with bonds. So you can't necessarily paint all bonds with that same broad stroke. But in general, you know, as rates start to rise up, you're going to want to get more conservative with your bond positioning, and understanding how, you know, longer term bonds are going to be more reactive to rises in interest rates versus shorter term bonds. And you know, credit and the coupon payments off of the bonds are going to have a different impact as well. And you know, last but not least, you know, to the extent you do get rises in inflation, and understanding where the real rates are and the movement of real rates, you know, Treasury inflation protected securities, which are another, you know, very, very high quality credit, also has the benefit to have a pickup in inflation as well. So, you know, you got to look at the overall bond portfolio and understanding how those bonds are going to interact with rising interest rates. And that's assuming that you get, you understand how the future movement in interest rates is going to be. I mean, coming out of 08, 09, you know, many times over, people tried to predict the rise in interest rates and frankly got burned along the way. So again, understanding your strategic allocation, understanding with that strategic allocation, you know, making some adjustments around in those asset classes within your fixed income, the sub-asset classes, how valuations are going to change and when it makes sense to be adjusting across them.
Thank you. The next question which was asked, I will refer to Bob to answer that. He probably has more information on this than most of us, and that is, do you see the US going towards negative interest rates? And are negative interest rates good or bad? Because given the rest of the world, we do have a lot of negative interest rates around the world. It doesn't seem to have affected them either way. What is your view on one? Will the US move towards negative interest rates? Are we in that situation? Or otherwise, it's not needed, we won't go there, and they're neither good nor bad, they're just a policy tool?
No, I don't see us moving toward negative interest rates. One, because they're not necessary. We have flooded the economy with money. and we've propped up the economy. We're moving ahead. European countries adopted negative interest rates because there was not a good alternative to fixed income securities. And so there had to be a propping up of that marketplace. There's also a generally accepted bipartisan aversion in our country to negative interest rates. So I don't see policy changing in that regard. So it is not necessary. I don't think it's doable. And I don't believe, as you indicated, Dr. Bhaskar, it doesn't really work that well. And the second part to your question?
The second one is, so if we are not going there, I'm sorry. The second part of the question is leads to something else connected to that. Are we going to de-globalize, given the current inward-looking, across the world, inward-looking policies, or are we actually going to not de-globalize? And if we de-globalize, what areas of interest, what industries would benefit from that?
I'll resist commenting on the pending election. No matter who wins, we're not going to de-globalize. I think we need to modify how we've globalized, and we'll continue to globalize. By that, we cannot de-globalize. We also have historic precedent for that. If you go back to the tariffs of the Depression era, it's counterproductive to stay totally inbred. We can't support this economy simply within our shores. So we will not deglobalize. We should not deglobalize. It's forced us to, it's forced our industries to become much more efficient. If you think about, I'll give you one example, the automotive industry that sold us, they actually publicized to us that they were giving us automobiles with planned obsolescence built into it. And then the foreign manufacturers came in and said, no, no, you can do much better than that. You can give a better product. And it forced us to create better products. We should not, we cannot, and we should not deglobalize. However, what we've done is we've given away a much of our industrial capacity, not yet our service capacity, because we still hold that, but our industrial and our commercial capacity to other countries. I think that's a security risk as well as an economic risk. And as we've seen, tie it to the opioid epidemic, it's a societal risk. So we have to become competitive here, not exclusively here, but in many of the basic industries we've given away. That also will speak, and I won't go back to the previous question, but that also plays into what will happen to inflation in the future if we have the moral and political courage to make those changes. But no, simple answer, we won't deglobalize.
Thank you again for those. And now there are some now detailed specific questions people have asked, and I would, any of you are willing to answer it is fine, but I'll start with Social Security is a major event in people's lives when they retire or when they should start Social Security. So there are some questions on that saying, is 62 a good time to start taking Social Security even if you're working full time? And the other one was, should you keep working even at 66? Should you keep working full time and delay Social Security till 70? Is there a general answer which can be given to that?
No, there's not. A resounding it depends. Social Security should not drive a lifestyle decision. Lifestyle decisions must drive Social Security decisions. So should you take Social Security early? Well, that's an economic. If you're still working part-time even, the answer is probably not, because you're going to give up money. Should you take Social Security earlier, even if you're still working? Maybe. I don't think there's anything wrong with triggering Social Security and dollar cost averaging it into a investment portfolio, rather than wait until age 70 and take the internal 6% rate of return on the uptake. So I think from a personal financial planning perspective, I think it's a resounding, it depends on the unique situation of the earner and the earner's family.
Yeah, I'm just going to sort of build upon what Bob was saying. You know, that decision from we'll call it full retirement age, because everyone's full retirement age is probably a little bit different on this call. But typically that 62 to full retirement age, if you're working, if you're taking it at 62, there's some money that's being left on the table. But again, that's a lifestyle decision. I don't want people to be, putting themselves in jeopardy because they want to delay taking their financial jeopardy because they want to delay taking their Social Security. But from that full retirement age to 70, that just becomes frankly, a cost of capital decision. And also it's a life expectancy decision as well, because if you delay taking the 70, yeah, you get that extra money as Bob was saying before, but you got to live longer over that time period as well to give up those periods of time where you're getting less benefit. So that's a life expectancy decision, and then also an earnings on taking it out decision as well. But in general, that's 62, call it that 62 to full retirement age. That's where I'd say, if you could swing it, you probably want to wait as close to that full retirement age as possible. Full retirement age to 70, that gets into a life expectancy versus earning on your money decision as well.
We have some new questions coming in, so let me read them, and I'll address them to whichever way we want to go. For Shauna, I think, what event would signal the beginning of a rotation from growth to value equities?
Sure. Right now, there is a tug of war sort of between growth and value stocks. On any given day, growth is outperforming value or vice versa by 200 basis points or more, which is rare. But it seems like it's happening every day right now. But the event that's going to change that, nobody knows, obviously, but the one that I see, and I mentioned it earlier, that could be a catalyst for that, for value to outperform growth, would be a vaccine or a treatment for coronavirus. In that instance, that could spur inflation. Like I said, demand could outstrip supply for goods and services, and it could cause value stocks the rotation to take hold finally, and for value stocks to start to outperform growth stocks.
So here's another good question for financial planning purposes. Some employers have suspended or reduced matches to your 401k or 403b for employees. Any specific advice for an individual, assuming sufficient emergency reserves already? Should I try to replace that missing match with my own payroll funds, or keep saving it as cash in your non-taxable account, I assume? Or
the math answers the question. Continue. I'm sorry, Matt, were you going to jump in?
No, go ahead, Bob. It's fine.
The math answers the question. Even if there was never a match, you contribute your money to the maximum that you can in your own cash flow management into your retirement plan. It's a tax deduction, and it accumulates tax deferred. It is very hard to overcome that tax savings over time by instead putting the money in a fully taxable environment. Sit down with the calculator, and you'll prove it to yourself very quickly.
Yeah, I agree with Bob. I mean, you got, assuming that you understand your personal cash flow, you got to give as much as possible to your 401k. If after you've given as much as possible and you still want to, you've maxed out to the levels from the IRS, and you still have that cash flow available, at the levels to do it, Roth IRAs certainly make a lot of sense. And even if you can't contribute to a Roth, there's ways of doing what I call a backdoor Roth, where you can make the non-deductible IRA contribution and then convert it to a Roth IRA that way. But so assuming that your goal is maximizing your retirement savings, you should definitely put as much as comfortable up to the max of your 401k. and then look at Roths or non-deductible IRAs as an option as well to get you there.
Okay, I think that.
Before you go to another question, would you indulge me to return to a previous question just for one brief comment?
Absolutely.
That was the growth versus value, and I agree with Sean on this, but it should never be an either-or decision. So if I might, just a value stock for people who are not necessarily locking onto it, a good way to think of it is the traditional economy, old economy, cyclical stock, an equipment manufacturer. And a growth stock would be an innovative company or portions of the economy that are driving new invention, the cures, those sorts of things. Well, I'm going to suggest that the old economy is the customer of the new economy. They're not two separate entities. And so you should always have both in your portfolio. But if you're looking at maximum growth, the growth sector is going to drive your growth. But the value sector that is cyclical is going to provide higher dividend income over time. And put them both together. The key is to find out what segments of the old economy are going to benefit the best from the new economy, efficiencies, labor saving, that sort of thing. And that, by the way, plays into containing inflation, going back to one of the original questions. So it all works together. It's sort of ordained to work together. So you should always have both, but a heavier emphasis on growth, not forsaking value. And I'll end with, you can never know when to make the switch. So just take what I said as a given and position the portfolio that way. And I see Sean agreeing.
Okay, thank you. There are a couple of direct questions which were asked earlier, then some new ones coming in. So let me ask you, try to consolidate them. From a tax point of view, which state is best when you're retiring to establish residency? Along with that, are there any recommendations beyond Roth for tax deferred growth or tax deferred investing?
I'll take this state tax question. So obviously states with no taxes are better than states with taxes, but first and foremost, you have to want to live in that state. So I would not make necessarily a living decision based upon the tax. I make this living decision based upon where I want to live, because if you're going to make it, you got to live there and for so many days a year or so many days over a number of years in order to qualify to be a resident in that state. It is just not hanging out there, every couple of days and saying you're now a Florida resident. And also you have to realize that it's not just the income taxation that's a factor. There are other forms of taxation that are there as well. So understanding what's the property taxation, what's the sales taxation, understanding what the give up is behind it. So I would not necessarily make a decision to go someplace from the zero taxation alone. So Florida is the one that just sticks out in my mind, because people like to say they pick up and go to Florida. There's more involved decisions in that. Getting back to the tax deferral strategies that you mentioned before, Roth is the biggest one. Certainly, if you're in addition to your normal job, if you have another job, consulting or other jobs that are out there, there are certain self-employed plans that you can do as well. Again, everyone's situation is a little bit different, so I'm not going to necessarily say this investment vehicle is best for everyone, but there are some people that will approach certain types of annuities that are out there that sometimes is a four-letter word in this space, but if you can evaluate, and there's certain ones out there that may or may not make sense, that's a way in some cases of getting some deferred growth that's out there. Again, I'm not advocating for annuities by any stretch. That's just something that people will sometimes look out there as an option as well if you're really bent on that deferral of savings. But then also what you can get down to is just making sure the tax management in your non-IRA assets makes sense. I mean, you can get a lot of deferral in your growth by just having smart tax management and smart rebalancing within your non-IRA investment assets.
I'd like to piggyback a comment on Matt's good comment, two of them. One is that I agree, tax deferred annuities are a very, very distant choice because one, they oftentimes have a lot of built-in costs, but even if you're using a very skinny down, there are a lot of restrictions. It's not nearly as good as a Roth. Now, one thing to consider, and the reason I wanted to piggyback is that if one experiences a period of unemployment during a year, job layoff, whatever the case might be, and you're driven down into a lower tax bracket, get with your advisor and take a look at doing a rollout of your IRA money, your 401k money, into a Roth during this lower tax bracket year. The rollout itself does not raise your bracket. So if you went from a 40% bracket to a 20% bracket, I'm just making it up, during that period of time, this might be a time to roll money out, pay that tax, especially if you're younger. And then later you won't be required to withdraw it as you would from a 401k or an IRA. And you can defer indefinitely into the next generation without taxation.
Yeah, that's a great point, Bob. That's a really great point about particularly those that have been laid off or are going to be in a lower bracket this year.
So there are some more questions coming in directly, so I'm going to skip some of mine and go to the ones. What advice do you have for ethical investing? For instance, not contributing to the end of the earth by unintentionally supporting fossil fuel firms who oppose environmental sustainability. So
I'll take it from a different perspective then. Not choosing, because everyone has their own views on that, whether it be war materials, whether it be fossil fuel, whether it be tobacco. At our company, we have an aversion to tobacco stocks, but that's an individual choice. But rather, the aversion shouldn't drive your investment selection. First, you should screen as an investor, and your investment team should screen for the best investment opportunities and then weed out from the best opportunities the ones that violate your value proposition. That's the right approach. So often it goes the other way. Let me find all the companies that don't, I'll take one of my pets, and that's a pun, issues, test on animals. Well, you're going to end up with a lot of kindness soap companies. You're not going to end up with the best investments. So you then have to do it in reverse. You've not done the right thing and singled out the best investments. So start out with what are the best investment opportunities, then screen the ones that violate your beliefs. The other point I'd like to make is that it can be done with a mutual fund portfolio. It cannot be done with an ETF portfolio, but it can be done with a mutual fund portfolio. And there you have to screen the top 20 holdings, which usually represents 60 or 80% of the portfolio. You can never screen all of the funds and all of the holdings in every mutual fund to get there. So once again, the same process. On the other hand, if you're buying individual stocks, it's a lot easier to go ESG or whatever it is your persuasion might be when you're doing it that way.
thanks again. So another couple of specific points which have been brought up. One of them was, you mentioned annuities, and I think we covered that a little bit. What about target date funds? Do you think they serve a good purpose? Do you have any of them in your firms, or do you recommend that be done outside? Or that's one. The other one was your view on for insurance on long-term care policy. Do you help people out with? I mean, do you engage with them? Do you recommend those insurance policies for the longer term?
I'll jump in. Target date funds are excellent. We have a retirement services department, and we have a large amount of assets that we handle for companies in their 401ks. The bulk of employees are in any plan are younger. and they're amassing assets. So to try to diversify individually for each participant when they're putting away $150 a month, it's far better to take the foregone conclusion of an asset allocation in a target date fund. And a target date fund is one that's geared to your expected retirement age. So then it will allocate it based on that. So we use them extensively for basically the rank and file employees who can't handle it individually within the portfolio. Long-term care insurance, I think, needs to be evaluated for every family unit. The sweet spot of the demographic that needs it are the people who have amassed a fair upper middle class amount of assets from high 6 into low 7 figures. Those are the most vulnerable to a spend down for a 2 or 3, 4 year, and the average is 3 to 4 years nursing home stay. You'll eat up a lot of those assets. That it's a good thing to insure against, to evaluate insuring against. But even for somebody with multi-millions, it can be an estate preservation technique. It's far better to pay the insurance premiums than it is to have 300,000, 400,000, 500,000 go out in nursing home costs.
Just to add on to what Bob was saying, you know, sometimes people can take a look at the cost of a standalone long-term care policy and kind of get sticker shock, and where they may make the claim that I will never need that. You know, there are certain life insurance policies out there that have the ability to use some of the death benefit for long-term care coverage. So it's one of those things where if you don't use the benefit for long-term care, it's there for within the life insurance death benefit at the end, assuming that you want to go down that path. So there are a number of different ways of approaching it. It certainly is something you're going to want to take a look at, especially as we have a number of people, and I'd call it that sandwich generation, where they're caring for their parents and they don't want their kids to be having to worry about caring for them. So, but yeah, those are a couple things that I would, you know, certainly look at it. But then also, if you're adverse to, because it can be a more expensive standalone policy, take a look at maybe evaluating it in conjunction with a hybrid life insurance policy.
The hybrid idea is a great one. We've just, in the last year, started to look at those and use them much more so than the traditional. But if you consider, look at the actuarial tables for the listeners, your chances of dying are less in any given year than your chances of going into a nursing home. Even for young people, think of motorcycle accidents, automobile accidents. So statistically, you're insuring a greater risk. It's only in the later ages that death becomes a higher statistical probability.
There are two new questions. Both of them are excellent. They are not related, but we do need to give time to both those. The first one is from Eric. I remember him from a time ago. His question is, if higher education becomes free, what do we do with our 529 and Coverdell balances? Would you expect a tax holiday to allow funds in these accounts to be withdrawn penalty-free, or would you expect the penalty and taxation to be enforced despite a change in policy that makes these accounts less useful for their intended purpose?
You're asking me right now to predict Congress, which is maybe a little bit more irrational than predicting the markets. So if the 529s, so if college is free, which I don't necessarily think down the line you're going to see free college. I mean, certainly all college. I can't imagine all college being free. A couple of years ago, during President Obama's administration, there was talk with tax legislation of changing the taxation or the deductibility with the 529s, and that actually went nowhere fast. Certainly, if you have a 529 balance now and you're worried about sometime down the road, you can use about $10,000 of 529s now to pay for pay for private elementary or secondary schools. So if you want to start, you can actually technically start using your 529s now to the tune of about $10,000 for doing it. But I mean, again, I'm trying to predict Congress. I guess if I have to think out, and they make tuition free, where they abolish 529s. I can see them probably eliminating the penalty, and maybe rolling it into a 401k, or using it for some other needs. But between vocational schools, between elementary schools or secondary schools, I can see some uses for bleeding it down. That assuming the very premise that education is free in the future, and or 529s are abolished in the future, which would both take significant acts of Congress.
I would tell Eric not to cash out his 529 plan because, Eric, and I agree with Matt, we don't know what's going to happen, but it won't be universally free. I don't believe that you can choose Harvard or Duquesne and both will be paid for by the taxpayer. And in fact, by the way, the political candidates who advocated free education weren't selected by the electorate. So if there is a degree of free education, it's going to be basic education. Your 529 plan will be used for the extra. It'll be the more expensive school. It'll be law school. It'll be medical school. It'll be specialized training to become an airline pilot after you've been graduated from school. So don't cash them out, Eric. They'll still be valuable.
And this last question is important to all of us because we all want to leave legacies in our lifetime. But Jeffrey has asked this question, is very relevant. Do you have advice for leaving a legacy or establishing a foundation to fund work towards a goal? What parts of a portfolio, which assets should be used for this purpose, such as an IRA, individual stocks, mutual funds, taxable real estate, advantages and disadvantages of asset types?
There's a lot of options that you can do with establishing some philanthropic legacy. IRAs are great uses of it. Down the line, you can actually, now if you're over that age of 70 and a half, you can start taking money from your IRA now to avoid up to $100,000 of your required distributions, to having that go to charity. You can start, establishing what's called a donor advised fund right now. You can start establishing some of those with, in some cases, as little as $5,000. What assets do you use? If you have assets, appreciated stocks with capital gains, those are great assets to use because you can contribute those assets to a donor advised fund. That's a little bit easier to do than even setting up a private foundation. And you could, contribute those assets. That's a way of rebalancing without triggering any capital gains tax. Donor advised funds are a little bit in the crosshairs. They're kind of getting some bad press in the media right now because they don't have necessarily the same administrative or restrictions as a private foundation. Your ability to give to them is a lot more flexible than a private foundation, but they're a great tool to use for future charitable giving, and they're a great tool to teach your children about charitable giving as well. Certainly, stocks versus cash has different tax treatment and deductibility treatment that you'll have to work out with your accountant, which makes sense or not. But by and large, most of the time, our clients are using their appreciated stock that has capital gains to make these charitable contributions.
We're almost out of time, and we have to bring this to a close. There are some other questions, but for all the panelists, thank you for joining an esteemed panel. And the panel has been gracious enough to say, if you would like to talk to them or communicate with them in person, please feel free to look at their websites for obvious answers. And if there's some more advice you would seek or want to talk to them, please contact them in the information which will be provided at the end of this session. So that is a good thing to have for everyone to follow up on specific questions and seek advice. There are some unanswered questions. We will get to them one by one, but I can't do it right now because we are almost out of time. So I would let Audrey take over.
Well, thank you to Professor Bhaskar for moderating our program today and for our excellent panelists for their advice. I'm sure our alumni appreciated it, and sorry if you didn't get your questions answered, but as Professor Bhaskar said, you can also follow up with one of our panelists. We will be sending a follow-up email to all registrants and participants today with a recording of today's program for reference and sharing. If you have any questions or suggestions for future programs, please email the alumni office at alumnionline@duq.edu. As always, we hope you'll check our full lineup of virtual programming, including our virtual homecoming weekend program, which will be September 21st through 27th at myduquesne.duq.edu. I hope everyone has a great day and invest wisely. And as always, go Dukes.
Bye, everyone.
Thank you.
Thank you.
Thank you, Shauna. Thank you.
Yeah.
Bye-bye.
Bye-bye.
Bye, everybody.